You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it's Tuesday. It's interview time here on the old Options Insider Radio, where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the aforementioned network. Hope you guys are enjoying the slew of content hitting the network these days. Pretty much something every day, if not multiple shows a day out there. We see it. We see you guys coming in mass these days. We understand it. These are trying and turbulent times for everybody. So we're happy to provide you some education, some information, some analysis, maybe a little bit of entertainment sprinkled in there as well. We'll keep you informed, up to date on the world of options. If you like what you hear, make sure you keep those reviews coming in your platform of choice. You know, the network's been around forever, 13 plus years, but we love to see new people discovering it, and these days they are doing so in mass. If you want to keep that slew coming, head on out to your platform, wherever you listen to this. Could be iTunes, Stitcher, TuneIn, our app, wherever you get this content. Leave a nice review so other people can continue to discover this network. And, of course, keep those questions coming. Maybe you have a guest you'd love to see us interview on the network here. Hit us up. We do love to hear from you guys. And joining me on the old interview program today, a newcomer to the program and indeed to the network, he is FELIX FREY, the founder and creator over there at OptionsGeek. FELIX, welcome to the Options Insider Radio Network.
Thanks, Mark. Thanks for having me. I really appreciate it. It's awesome.
And FELIX, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give us a little bit of an overview of your background in the options space, as well as what it is you guys do over there at OptionsGeek.
Sure. So I graduated in 1995. I started Wall Street in Chicago, actually, where you're at Swiss Bank O'Connor with the O'Connor Partners. I went through their training program, and you know, and most of your listeners probably know that O'Connor was one of the best trading houses in Chicago and on Wall Street at the time. I learned from that group. Eventually, wound up at Bank of America in New York City. I was dealing on the derivative side, equity derivative side. I was dealing with the top guys in the world. Had that experience, and then actually was recruited over at one of the top hedge funds over the last 30 years, Scoggin Capital Management. Sat side by side with two of the best risk management group in the business. And after that experience, during my whole career, I've identified a big problem in the industry, and I've built OptionsGeek to tackle that problem. And that the problem can be summed up with really one question. I say two, but really boils down to one question, and that's when you're buying an option. How do you actually choose which is the right option? And the things that go into that are, you hear a lot of people say you want to buy options to shift the odds in your favor. The problem is nobody really explains exactly how to do that. And so at OptionsGeek, I teach a lot more about risk reward. I'm switching the conversation from the Greeks and implied volatility and I'm switching the conversation more to this risk reward, probabilities, odds, and payouts. So that's what we're doing. It's a game changing education, and I built a tool that it really, I think, takes us from where we are today to the next phase of the evolution of the options industry.
You know, when they suggested you for this program, and I started looking over your systems, and you kind of mentioned it just there as well. One thing immediately stood out to me. We get inundated all the time with people hitting us up to come on the network who are, various gurus in the options educational space. At least they term themselves that. And 99.9% of them are hitting us up with platforms and products about premium harvesting, about selling options. They hit us up with all the same old tired mantras, whatever the percentage is, 60, 70, 80, 90, whatever they're touting out there, some ridiculous percentage of options expire worthless. Only idiots buy options. I'm going to teach you how to sell options and make all this money and all these things. So off the top of my head, I'm hard pressed to think of someone we've had on the network recently, at least from the educational side, who was extolling the virtues of buying options. So for that sake alone, Felix, makes you a little bit unique out there.
That's good. I think I have a lot to say about everything you just said there, but the what most people don't understand or don't know, maybe they just don't know because nobody told them, but the top guys in the world, and what I call the top guys in the world, let's call it ex Warren Buffett, who sells options, because everybody likes to say, I want to trade like Warren Buffett, I want to sell options. But Warren Buffett sells options once every 5 years, so it's not really practical for the average investor to actually build a career or build their wealth with, a one-time trade every 5 years. Most of the top guys in the world, and I mean the guys you read about in the newspaper, CNBC, the Ackmans, the Einhorns, the big hedge fund guys, Soros, Icahn, they are buyers of options. And they buy options essentially for the limited liability and for the leverage. The limited liability meaning I can only lose X, what I put in, and the leverage because I can take $1 and turn it into $4 or $5. So, this notion that the top guys in the world or the biggest professionals in the world are trading iron condors, that they're doing buy rights, it's not true, frankly. I mean, in 20 years in the business at the highest level, I've never executed an iron condor for myself or for a top professional. And I think it's important to for me at least to get that out there and to say that there's other ways to look at options. I don't say that buying options is better than selling options. I simply say there's two ways to trade. And if I was going to do something, I want to trade it like the best guys in the world. And I know the best guys in the world, they buy options for those two things, the limited liability and the leverage.
Well, that is true. Once you get into the fund arena and the large asset managers, you're right. They're doing things that most even advanced retail would probably consider simplistic. They're buying puts or put spreads or selling covered calls. That's 90% of what they're doing out there. You're right. They're not doing iron condor ratio swaps or anything like that. But you kind of mentioned the strategies out there. I'm curious. We're talking about buying premium. There are a million different ways to slice that onion. How do you like to look at buying premium? What's your preferred methodology? Are you going out there just buying straight up single leg options? Are you buying verticals? Are you doing the aforementioned iron condor? What is your preferred MO when you're out there buying premium?
Sure. I teach people how the best guys in the world do it. And they are buying options. One, we've established that. They're buying out of the money options. Two, they're avoiding spreads most of the time. Okay, so if I had a handicap it, I would say 90% of the time they are buying puts to express their opinion lower or buying calls to express an opinion higher. They are, again, they're staying away from these spreads. And the reason they stay away from the spreads is because they want the leverage. And essentially, they don't want to be, the last thing they want to do is buy a put spread and have and sell this downside put for 50 cents or $1 and have COVID-19 come and they make $10 instead of making 50. And it's more painful for them to actually lose out on the massive win than it is for collecting these, 50 cent out of the money puts or out of the money calls, in this call spread. They're not doing calendars unless really they're rolling. Very few do these calendar trades and try to make 30 cents. They are targeting, this is very important, they target returns of 150 to 400% on every trade they look at, right? So if you called up any hedge fund with an idea and said, I have this great idea to buy calls, and they said, okay, what can I make? And you said, you can make 50%. they would hang up the phone and really not pick you up again. You'd be in that box where a box of people that really don't understand what they're trying to achieve. So they're actively buying puts. They are avoiding spreads. They are buying out of the money puts. They are targeting 150 to 400% returns, and they're usually not buying weekly options. They're most likely buying in the range of, call it 3 weeks to 12 weeks. That's probably the range. So that's how I look at it. That's what I'm teaching. I'm teaching people how to do it. And then more specifically, I'm teaching people how to specifically choose the right option, right? Because that's the question. I'm out there publicly saying 99% of the people, including people on Wall Street, don't know the answer to that question, or at least can't explain and simplify that answer in a way that someone can understand.
That's funny. So you're kind of taking the opposite side of the vast majority of what we're seeing out there. A lot of the, so-called educators out there, like we mentioned, are talking about short premium. So you're taking the other side of that trade. A lot of them are fixated almost 100% on the weeklies or very near duration contracts for obvious reasons. They want to get that maximum theta decay. And a lot of them also are going on spreads. You're going long premium. You're going farther out than the weeklies. You said at least 3 weeks, if not longer. And you're not doing spreads. You're doing outrights. So it sounds like, Felix, you're taking a different side of a lot of the other educators out there.
I'm doing what the best guys in the world do. That's how they trade. That's what they're looking at. Look, here's the thing about one, I'm telling you that there's no education out there that teaches you how to buy options. And part of the reason why most educators are selling options, because it's easy to teach. It's very easy to teach someone how to sell an option, just, actually how to do it. Doing it correctly, okay, takes a process and whatnot. But, people shy away from teaching how to buy options just because hasn't been an explanation. There isn't any. You can't find any education that is going to explain to you how to actually do it and gain an edge or do it for your view, for your unique view on the stock. And that's to me, that's an incredible statement. I don't say it like, I don't, take it lightly. It's an incredible statement to tell you and everyone else that 99% of the people don't understand how to buy options, or they can't prove to me that the option they're choosing is the right option, which means that they're guessing. And what I am telling people out there, helping them understand, is that options are essentially a probability game. When you look at the options chain, at the options board, it's a probability board. And if you're guessing at a probability game, if you're guessing at any probability game, it's likely that you will lose over time. And that is the reason why people lose buying options. It's because they're not choosing correctly. They don't know how to choose. People have this notion that, when you buy options, you should buy low volatility because that's what the industry has said. But in fact, in the last, I can prove that incorrect, because over the last couple of months, volatility has been as the highest it's been in the last 15 years. And you still see people, the top guys in the world buying options hand over fist. So, it's not what they look at. The top guys in the world are not looking at this implied volatility. They're not looking at the Greeks. They're looking at price, what they pay today versus what they think the option is going to be worth in the future, which has more to do with parity relative to where their target stock price is. And then there's this relationship of risk-reward analysis that they're doing on that observation, right? Because the top guys in the world, they want certainty. They want to make a decision. They want to make a guesstimate on and only take one guess, right? Which means they're going to need some certainty here and there. If they start guessing on implied volatility and the Greeks, it's too many guesses, right? They know what the options cost today. That's certain. That's a certainty, right? What does it cost? Forget about what the model says. I don't care if the model says it's $2, $5. If the market is pricing it $1 to $1.10, that's the price I have to pay. So that's the certainty, the market price today. And then they're focusing on where the stock is going to be in the future, where they believe the stock is going to be, and what parity is to that price. And then do an analysis between today's certainty and that certainty. That's the only thing you know for certain. And they make a decision based on that. That's how they trade. And what I teach is that analysis of the risk reward and how you can do that. And I built a tool to do that for you. So I teach the concepts, and then I've built this new options chain that allows people that gives people the answer to which one you should buy.
Now, you said something that's kind of interesting to me. You mentioned how the Greeks are kind of worthless. That's kind of a cornerstone of what you're teaching over there, which is, again, very different from what we've seen. Most other educators, they'll start you with a basic understanding of the Greeks, your delta, gamma, theta, vega, what they mean in an options price and how that all contributes to the whole, and understanding each of those mechanics and how they interact can lead to successful trading. Sounds like for you, that's not the focus. It's just net price. So someone coming to Options Geek, they're not going to have your traditional seminar on the Greeks there, Felix?
I take on the Greeks in 22 minutes over 6 videos. And I only do that because if you want to know the advanced concepts like skew, if you just want to understand it, then skew is one, pinning, or, what they call gamma wells, or, max, people have it like max loss or maximum gain calculators, whatever. Then I give people sort of a 22-minute version of the Greeks, and this is what you need to know. This is it, and I take those concepts and I explain skew. I explained pinning. I explained a couple of other things like put call parity, and help people understand the higher level concepts. But at the end of the day, do you really have to know those? Not really. Can you just read what skew is and, read higher, low, implied volatility and what that means? Sure. But if you wanted to get into the details, I teach that. Really, I stay away. When you're actually executing options, I stay away from the Greeks and implied volatility because essentially it's a guess, right? If you want to talk about what your theta is today, it's going to change the minute the stock moves. So, as soon as the stock moves, then your theta is going to change. It's a 5-dimensional puzzle, and it's impossible to be correct on all the Greeks and what I explained before. Once you figure out, if you're making the decision on certainty, right? If you have, let's just take 105 call option and on $100 stock, and it's a 2-month option. If the stock actually makes that big move to 110, how much time value is left in that option? Very little. It's going to be worth 110 minus 105. It's going to be worth $5 plus some time value, whatever the put's worth. The 105 put's probably worth 30 cents, depending on where the time is, but it's not going to be worth that much. So even if you got it all correct, even if you were 100% correct on the Greek and implied volatility, the only thing it's going to affect at the end of the day when you hit your target stock price is that 30 cents extra. So it's meaningless. It's meaningless. If you're looking at it the way the big guys think of, it's meaningless. Now, do they look at implied volatility as a guide? If it's 30 volatility, no big deal. If it's 100 volatility, they're going to have to think about it and make sure that their target stock price and their risk reward analysis is correct. They're going to focus back on the idea. Is my idea correct? And that's how they look at it. It's not, think about this. If there's an option that's $1, Mark, and you think it's going to be worth $5, so it's going to be a $4 payout, winning payout for you. If I told you the option was worth a 20 implied vol, or a 40 implied vol, or a 60 implied vol, or 100 implied vol, or 1,000 or 10,000 implied vol, it doesn't matter. It's still worth $1, and you still did the analysis to believe that it's going to be worth 5 at parity in the future. So the implied volatility is not going to matter, and that's why it doesn't matter. That's why it doesn't. It's in fact backwards thinking to go into an implied volatility ranking system and then go say where are the lowest implied vols. Those are the ones I want to buy. It's just not what the average investor does. Now, given all of that, I do want to say that the education that's out there is good. It's actually, some of it's great if you want to be a market maker, if you want to be a Goldman Sachs derivative trader. I worked at Bank of America as a derivative trader. If you want to be a derivative trader at an investment bank or a market maker, then clearly you have to know the Greeks, you have to know implied volatility, and you have to know the Black-Scholes formula like the back of your hand. But for everyone else, for the 99.9% of the people that are never going to do that, then you're not thinking about options that way. You're thinking about, I like Apple. I think it's going up. Which call should I buy? I like Micron. I hate AMD. Whatever it is that you think. The only thing that can make an option cheap or expensive is what Mark thinks about the stock, which is going to make the option cheap or expensive, or what I think about stock. That's it. It's unique to the person.
Now, one of the downsides, people often point out when you're talking about buying premium is what I like to term, the death by 1,000 cuts. You could be right on a movement, but if it doesn't happen usually quick enough, you want that move to happen fairly quickly when you're long premium for all the things we just outlined earlier, the theta decay and everything else. So that's why a lot of people like to use spreads to mitigate some of that outlay, to maximize their potential to have that initial purchase kind of make sense and minimize their risk from that perspective. But you're out there buying outright options. So do you try to mitigate that death by 1,000 cuts? Really, is it just come down to picking the right time frame and strike selection? Is that how you try to do that? What's your methodology for avoiding being, essentially decayed to death?
To avoid some of this decay, I like to get people to focus on the stock, focus on the risk reward of where they think it's going. I also ask them to focus on an event, right? Options, you just don't want to be long an option just to be long an option, right? The way the top guys think about it is that they're anchoring their position on an event. What's the event that's going to move the stock? Is it earnings? Is it an investor conference? Is it, it could be an event, could be a technical event that there's going to be a move, you think there's going to be a move, break it through in a technical in the next week. What is that event? And focus on that event and focus on how that event is going to dictate where the stock's going to be in the future. So that's going to take care of your time. And if you're focused on an event, then you are taking out, usually you're focusing on the same event everybody else is looking at, right? So if you're focusing on earnings, you're taking out the decay to some extent because you're waiting for that event. You think that's the event that's going to cause earnings to come out, be good, the CEO is going to talk, and the stock's going to explode to this level. So what we're looking at is basically anchoring the options to an event. We're looking at price and doing an analysis between risk reward. And yes, death by 1,000 cuts in options buying, the user can only expect to be right probably 30 to 45% of the time. Okay, but it's a different mentality than selling. Most people want to win. The mentality is I want to win 70, 80, 90% of the time, 95% of the time. But the market, it doesn't work that way. You can't say that's better than buying because when you're selling, okay, and you're winning 70, 80, 90% of the time, what the market is essentially saying is that you're going to lose 30, 20, or 10%. And when you lose, you're going to actually lose pretty big. Okay? And that's going to be the experience of most people that are selling options or selling premium in general. In buying, it's the opposite. You're expected to win 30 to say 45% of the time, but when you win, okay, you could expect to win a decent amount, multiples of what you put in. And that's the game. And so finding those good positions, finding those positions where you can actually anticipate winning 150 to 400% returns, I only have to be right 35, 40% of the time to do very well. And that's what I teach. And how do I actually find those positions? To get the ideas, I actually use unusual options activity. Now, there are many people that use unusual options activity these days, but there's a very specific way to analyze it, to find the data, find the correct data, use the data to get the answers you need to make a better guesstimate as a guesstimate on whether or not that's the option you want to buy. That's the option you want to piggyback. So through my experience, I understand from dealing with the sharks, I call them the sharks, dealing with these guys, I understand what they're looking at. I understand what they're looking for. I understand what they're trying to achieve. And so when I'm looking at these unusual options activity, I can pick sort of the 10 that I really want to focus on and then dig deeper with my analysis to find one or two. So I try to make it practical for people to actually use unusual options activity. Because right now, there might be 200 unusual options activities each day. How does someone actually filter that? How does somebody actually use that information? And what I do is I help people, one, on their own through the education, I help people narrow things down, or as part of a product on OptionsGeek, I give my ideas 2 to 4 times per week. So death by 1,000 cuts I think they mean that you will lose more often than you win, but when you win, you should win big. So it's a different mindset than selling.
Well, these are certainly interesting times to be talking about being long premium and buying volatility. You're certainly on the right tip from that perspective. Just look at the last few months we've had out there in the market. In fact, I was joking with some of our regular contributors here on the network that we were actually talking about buying long straddles recently on the network, and it actually worked out. That shows how just unprecedented these times are. These are the kind of markets you need to really make buying long straddles on a regular basis tend to work out. But really quickly, before we wrap up here, Felix, I'm just curious, these have been somewhat unprecedented times in the market. You know, the massive sell-off in March, the equally massive and equally unprecedented rally we've seen out there right now. What are your thoughts on what we've seen out there in the marketplace from an overall valuation perspective, from the volatility perspective, what we're seeing out there right now, as well as what it's been like out there buying premium through all this?
You know, I think, we've had a great run. I think I would say that first and foremost, the beauty about unusual options activity, when we find buyers of options and it's the ones that we want to go along with, the beauty is that we get to take the idea from the hedge fund, right? When a hedge fund has a great idea, when the hedge fund it feels like they're going to make a lot of money, they run to the options market. And you could see that real time. And so before they even tell their friends, they're buying the options, which you're getting a look at. And so that's whether it's high vol periods or low vol periods, there's always going to be that run for options by these hedge funds when they have a great idea. So I would say that some people say that it only works at different time periods. I would say it's been working for quite a while. It just happened to work a little bit better from February into April because we were long a lot of options, and all of a sudden everything exploded as far as volatility and things moving around. I would say that the market is in a tough spot here. I would think probably the most interesting thing that I'm thinking about right now is the millions of followers of this guy who's on one of these other networks. That there's just millions of people that are getting long names just because they're following the other millions of people, and you're getting these big moves in stocks. And I'm not sure how long that lasts. I just, at some point, how high can you take every software company, and make them 40% of the S&P 500? Like at some point, it's too much, right? At some point, there's other things out there. I don't know what that point is, but I think that in the next year, you will get these spurts of very high volatility, and then this month and a half, 2 months where volatility comes off, and then you get another spurt because it's going in different directions, trying to find ultimately wherever this market wants to go.
Well, Felix, unfortunately, that music means we've come to the end of our little sojourn here. But before we go, if folks are intrigued, they want to learn more about buying premium and all the things you talk about over there at Options Geek, where should they go? What should they do?
They should go to OptionsGeek.com, options with an S, OptionsGeek.com. Also, I have a free membership with loads of information and a lot of good things. Or you can just email me at FELIX@OptionsGeek.com, and I'm very good at answering my email.
There you go. Check them out, FELIX@OptionsGeek.com. Maybe you too want to talk about buying options. I hearken back to my old friend, Mr. Don Schlesinger, on Volatility Views back in the day, who said an option should be sold or not sold, never bought. He'd have an interesting thing, I think, to contribute to this conversation. That would be fun. But Felix, I appreciate you coming on here, and I look forward to seeing how all this and how everything at Options Geek unfolds here in the marketplace in the coming months, sir.
Thank you, Mark. I appreciate it.
We appreciate all of you for tuning in and listening and continuing to devour all of our content here, not just the interviews, but, of course, the options block, the options boot camp, the TWIFO, the volatility views, the crypto rundown, all the fun stuff that's hitting you guys, and a lot more. And we'll see you back here tomorrow. We've got OPR and boot camp heading back your way. Thursday, of course, we've got TWIFO and the option block, and Friday for vol views. And we kick it all off again next week with more Options Insider Radio.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.